Now, Wednesday is an absolute huge day for the economy. We've got two big things that are coming. One, the Fed is going to announce their interest rate decision tomorrow at about 2:30 in the afternoon, I believe, Eastern time. But before that, the Treasury rate is going to issue their decision on refunding. What does that mean? Are they going to change the mix of the debt? Will Yellen accelerate longer-term debt or continue to operate on the short end? She's gotten a lot of criticism for operating more on the short end, ostensibly to do some yield curve control, but analysts are saying she needs to go more to the long end to take away that short end risk. That may be wishful thinking given what's going on in the economy, especially with regards to risk immediately, and that's probably why the Treasury is not doing more long-term issuance. They're trying to affect the yield curve.
Welcome to Gold Silver Pros.
Hey everyone, this is your host Rob Keynes with GoldSilverPros.com. It is Halloween. The witching hour is upon us, and that may be the theme of the show. Bad stuff is walking, and bad stuff is coming. We're going to start off with the economic data. Then we're going to do a couple of stories of the week. I'm going to talk about something which I think is confusing a lot of people, and there seems to be a big divergence among people in sound money. And then, as usual, we're getting to the gold and silver report. This is your weekly market wrap. All right. On to the presentation. Here is the economic data for the week. GDP surges from last quarter, 2.1% print last quarter to 4.9%, and this is adjusted for inflation. Most of that's because consumers spent a lot more. Of course, that was almost exclusively using debt as their incomes are net negative when adjusted for inflation. We'll get to that in a moment. Inventory build in the economy and investment sector make up the rest. So a lot of money flowing into inventories, probably for year end, probably for Christmas. Durable goods orders accelerated a lot, which means manufacturers are producing a lot more. Companies are producing a lot more, which is a potential positive sign. And investment money flowing into various investments, I guess, heading towards end of year is very positive. We'll see what happens if there's stock loss selling in December, but we're a little bit early for that. We've got a couple months before we get there. Overall, I think a bit of a mixed bag on GDP because consumers are using debt and they can't do that for very much longer because debt's at an all-time high. It's over $1 trillion. We talked about that last week. But it's nice to see a little bit of ramp up in inventories, potentially a little bit more demand in the economy. We'll see if this continues into the next quarter, but definitely a little bit of a surprise print, although a little bit less than what economists were expecting. I think some economists were expecting a 5%, which I thought, that's a little high. We're headed until holiday season, okay, but still seem a little bit high to me. As you can see, durable goods orders surged to 4.7%. Most of that, because if you subtract transportation, is only up 0.5%. So most of that was a result of orders in the aerospace industry and transportation in general. Of course, there's war spending going on, but also Boeing plane orders were up, which is a nice sign. It means at least one of the industries are doing well this year. Pending home sales up to 1.1% after they had fallen 7.1% last quarter. Now, those are pending. Those aren't closed deals, but new home sales did surge to 779,000. So there seems to be a rush into real estate. Again, uncharacteristic because of the lack of strength of the economy. Consumers are definitely spending more, and a lot of it is on homes and investments. It's very interesting to see whether they'll be able to keep that up. A lot of new debt. Maybe this is people, a lot of times what happens when you go into the end of the debt cycle is people spend more at the very end. It's sort of a false euphoria or a sort of a schizophrenic euphoria as people spend even more going into the end, almost like they want to keep up their lifestyles. We've seen this before prior to other currency collapses and debt collapses. We'll see if that's what's going on in the United States. Really interesting to see what's going on in the data. But again, the biggest bullet point probably that matters the most in the long term to all the stuff that we're talking about today is that real wage growth is negative, according to the Bureau of Labor Statistics. On the markets, the stock markets are up slightly in the morning hours, heading, however, for a third straight losing month. We'll show you a chart on that here in a moment. The bond rates have moderated a bit, but the 10 and 2-year treasuries are still in a yield curve inversion. It remains slightly less than a percentage point at 0.925. Crypto was down in morning trading, but still strong. Bitcoin has surged to 34,274. Yesterday, it's down a little bit today. Ethereum is up to 1803, not at a yearly high like Bitcoin, but it's near August level. So a nice little pop in Ethereum overall, the crypto complex is not stupendously strong, but Bitcoin is definitely leading the way and doing very well this year. Now, Wednesday is an absolute huge day for the economy. We've got two big things that are coming. One, the Fed is going to announce their interest rate decision tomorrow at about 2:30 in the afternoon, I believe, Eastern time. But before that, the Treasury rate is going to issue their decision on refunding. What does that mean? Are they going to change the mix of the debt? Will Yellen accelerate longer term debt or continue to operate on the short end? She's gotten a lot of criticism for operating more on the short end, ostensibly to do some yield curve control. But analysts are saying she needs to go more to the long end to take away that short end risk. That may be wishful thinking given what's going on in the economy, especially with regards to risk immediately. And that's probably why the Treasury is not doing more long-term issuance. They're trying to affect the yield curve. Both decisions will have huge effects tomorrow on the bond and stock markets. We'll look to see if that's going to continue the downtrend in stocks, which we'll get to in a moment, but how that's going to moderate what's going on in the bond markets, given all the risk in the economy. That will be big, and we'll cover that, as it happens on the channel, especially on Twitter. Stay tuned to Twitter for more daily type of announcements. And then on YouTube, of course, we have twice a week videos. All right, here's the stock market. This is a chart that I did show, I think, on Twitter, maybe earlier this week or last week. We had on August 1st or around the very beginning of August an inflection point in all the stock markets. You can see that they're headed down, big maroon arrow there on the right-hand side of the chart. The Russell 2000 is down almost 6% in the year. It was actually down a little bit more until this week. It's actually had a little bit of positive bounce. You can see on the very bottom, a little bit of I would call that a dead cat bounce in the small caps. The Dow Jones is still negative for the year, although it did also have a little bit of a dead cat bounce in the last week. It's still negative. Both the S&P and NASDAQ are both down. So all the stock markets are down over the last 2 to 3 months. And of course, I think that's an indication that the consumer is not strong. The consumer is 72% of the economy. Weird GDP print this quarter, but I don't think it can last. Again, negative real wage growth on the consumers, and they're using credit. And you had some more spending in there, and you had a big order for Boeing. So is that going to continue in the fourth quarter? We'll see what happens. I mean, it definitely could if another sector of the economy decides that it wants to jump up. All right, now we're going to be on to the stories of the week. And for the stories of the week, I'm going to share screen as we talk about these. Lots of stuff going on, ladies and gentlemen, lots of stuff. And now on Spaces on Sound Money Mondays, myself and Daniel and Jim host Sound Money Mondays, 10:30 a.m. Central Time on Mondays, or 11:30 a.m. Eastern Time on Mondays. And one of the big things we talked about this week was housing, and whether the housing market was in a boom or whether it was going to bust or whether it was about right and they didn't see a big bust coming. And there were differing opinions on that. A lot of the audience felt as though, no, if you look at dollars printed in real estate hasn't bubbled any more than dollars printed. My point was that you're going to have a currency revaluation and a currency crash, and all assets priced in the dollar are going to crash along with it. Plus, if you add in the fact that housing prices are not affordable right now, look at this chart. Look at housing prices related to average income for the baby boomer generation when they were buying most of their houses. Now, this is a time chart, so this goes back in time. When my generation, the Gen X's, the millennials, are probably the biggest generation. Well, they are the biggest generation, but also in terms of being in the prime spending years, even though they don't have as much money. And looking at today overall, the average house price is way above the average income. And the point that I made on the Spaces on Monday was, if people can't afford houses, prices have to come down. Forget about interest rates being high. The prices are too high, and with interest rates rising, and that's why the Fed decision on Wednesday is such a big deal to the housing, stock, and bond markets. If they continue to raise rates, it's going to make houses even more unaffordable. And I think some of the rollover that we've had in 2023 with the housing market, this month's numbers notwithstanding, because they were actually kind of rosy this month. But overall in 2023, the housing market hasn't been doing too hot. The raising interest rates have lowered the overall amount of sales, and it's moderated the amount of new homeowners, especially in the younger generations. But just look at this affordability. You cannot tell me right now that housing prices can continue to stay up and not crash down when the average person has no chance in hell of buying a house. And existing home sales are down because people that are sitting in those 3% interest rate loans, 2 to 3 to 4%, are not going to sell and go buy a home at 8%. So I don't think going into the end of the year that housing can recover, and I definitely don't think it's going to recover next year when we've officially hit the recession. It's got to happen next year, given the data. So I don't think the housing market is strong, and I think it has to come back for those important reasons. But again, we'll see what happens with the Fed tomorrow. You know, that's fodder for good discussion. Leave your comments below, because I know a lot of people have very different views on what's going on in housing. But my point is, right now, it's not affordable. And two, when you go through a currency reset or currency crash, everything priced in that currency is going to come down. All right, the other thing that I wanted to talk about is commercial real estate. Office defaults are driving commercial mortgage-backed security rates higher. Highlighted part from Fitch. New 60-day delinquency volume increased to 1.24 billion in September from 780 million in August, according to Fitch. The majority of which were office loans, which accounted for 66% of new delinquencies, to the tune of $696 million. Maturity defaults, according to Fitch, accounted for 56% of new delinquency volume, while term defaults represented 44%. Fitch's U.S. CMBS delinquency rate, going back up to the top here, increased by 8 basis points to 2.07% in September from 1.99% in August. The increase was fueled in a surge by office maturity delinquencies. That's another part of the real estate market which is not doing very well. Retail's not doing well. Retail right now is very bad. One of these days, I'm going to go take a camera and just go look at the office space in my area. And again, I'm in a pretty nice area of town, definitely not bottom 50% in terms of quality of dwellings. I'm definitely in the upper half, and not necessarily the rich zone, but a nice retail zone. And retail in my area is absolutely taking a pounding. A lot of businesses are simply going out, and I'll take the camera and probably do something on that in the next couple of weeks, because it's just gotten worse. And I've seen this starting the last 2 years. Areas which had almost 100% rental rates, the vacancies are going, way, way, way up. Last story of the week is federal government expenditures on interest payments. With all the new debt issuance, which is mushrooming, we have a near vertical on the interest payment chart. And what does this mean? When you see a near vertical on the interest payment chart, it means the government's about to go insolvent. It means there's so much debt, and given the rising rates on the debt, that the federal government pretty soon is not going to have enough tax receipts or enough income to pay that off. Interest as a percentage of the overall debt is rising, and interest as a percentage of tax receipts is blowing out. Pretty soon the government's going to become insolvent if this continues. And unless we see interest rates fall, or the U.S. government, decides to stop spending so much money and driving new debt issuance up, this is going to go vertical on the chart, and the U.S. government is going to be insolvent. And that's another thing that could crater real estate prices, because what you're going to see is skyrocketing interest rates, skyrocketing inflation, and nobody's going to be able to afford a house then either. So this doesn't bode well for any of the markets, the bond markets, the stock markets, or the real estate markets, or anything that's based upon paper dollars. It does bode well for things that tend to absorb inflation or reflect inflation, such as gold, number one, and then behind it is little brother silver. Yeah, it's not looking too hot there. Of course, we're going to get into the gold and silver part of this in just a moment. But my general commentary is, despite some rosy figures coming out in the economy, I think the economy is in very dire straits. It's not looking good. There's a little bit of euphoria, because this is something else we talked about in the spaces on Monday. Most people are not paying attention to what's going on. Most people are paying attention to the World Series. Most of the people are paying attention to what's going on at the movie theater, or with their favorite soap opera, or their, whatever the case may be. People are not prepared for what is coming, and the economic data keeps getting worse and worse and worse, as you can see on the charts that I show you. And I'm not trying to be negative Nancy. I'm just trying to prepare people for what's coming. There has been capitulation. Well, we'll get into that in a moment, in retail selling. But let's go into the gold futures market first. This is from CME Group. We do live off of their webpage, and you can see a little bit of elevated volume in the last part of October for what we had before. Not really out of the ordinary, but there is some stuff going on, and we're going to show you that in the commitment traders report in a moment. And I'm going to get really pissed off there at the bullion banks in a moment. You're going to have fun when I get to that part. But let's go over the data. Now, this data is as of today at about 9 a.m. in the morning. So early morning trading. This will be updated later in the day for the 1 o'clock data, but probably not for another couple hours. The dominant contract month, or the contract in which everybody's trading the most, is December. That is the one that has the most effect on the near-term price of gold and silver. In this case, we're on a gold chart. Although you can see February and April starting to pick up some contracts. You see 1,259 contracts rolling to February, 35 for April, 370 for June. So they're already setting up next year's trade. But we pay attention to December data, because that's where all of the action is right now in terms of pricing. So right now, We had 181,000 volume today so far on the market. Now, the one thing that's happened in gold, but even more in silver, which is really astounding, is EFPs, exchange for physical. And this is what I focus on this report more than anything every week, because to me that matters more than anything right now, is the exchange for physical. What is exchange for physical? Well, you take a futures contract on the COMEX and you go to an over-the-counter contract in the UK market for gold. Now, over-the-counter contract, futures contract are different. Futures mostly is not delivered in physical. There's a very small percentage delivered in physical, and most of it is speculative gambling type of trading on what's going to happen in gold and silver. Some of it is legitimate hedging by producer merchants and maybe a little bit by the bullion banks for their clients, but most of it's not really hedging. It's speculative behavior. It's seeking returns like you're either in a casino or in, the stock market. So it's not really based upon the physical. The exchange for physical, however, is an indication that people are going for the physical. That's why it's called exchange for physical. And if you read the description of exchange for physical here on the CME Group's website, it basically says that people are trying to get exposure to that OTC market and ostensibly get exposure to more physical metal, because even though the OTC market is highly leveraged, there's probably more physical trade going on there than in the COMEX. I think the COMEX is the least physically traded of the major gold and silver markets, at least according to the published data. Now, we don't get a ton of data on the London OTC market. It's very opaque, but apparently there is more physical delivery there, I think, than the COMEX. If you just look at the percentages of the data that's available, and on Shanghai, it's very high delivered market. There's much more delivery going on the physical exchange market in the Shanghai Gold Exchange. But look at the EFPs. This would be Monday's data, 1,827 so far today. And this is early morning trading data as of 9 a.m. Central Time. So it opened up and bam, we immediately hit 1,827 contracts. Look at Friday, 3,974. Look at Thursday, 1,763. Look at Wednesday, 1,520. And look at last Tuesday, 3,291. So it's about 10 to 12 to 13,000 contracts of 100-ounce gold trying to go overseas to see if they can get access to physical. That's important because there aren't a lot of deliveries going on right now. October is not a busy month. You can only deliver in the current month's contract. So because there isn't a lot of trade going on, there's 85 deliveries. Well, that's Tuesday's data. Let's go to Monday's data. Most recently, 132 deliveries, and there wasn't any open interest left. Basically, the October market's liquidated because we're at the end of the month and now into November trading. We'll start to see November deliveries pick up, but there's only 1,399 November contracts. So really, the big physical deliveries on the COMEX are going to come in December. Why? Because you have all these contracts. You have to have a lot of open interest to get physical delivery, especially when physical delivery is only a small percentage of the open interest. So on these intervening months, not heavily traded months, you're not going to get a lot of delivery. And I think that's why seeking the physical is pushed over to the EFP mechanism, because people are trying to trade that COMEX futures contract to get access to the physical market. All right, long explanation there, but hopefully that helps for those of you that don't watch the channel a lot or are new to the channel. Now, on preliminary, we did get the 1:32 p.m. Data on the market in terms of gold price today on Tuesday, October 31st. So gold is down on the December contract about $11.30. That's the biggest mover of price. $11 in November contract, 10.4 in January, which tends to make a lot of sense when we look at the data. That's today. Full day's data yesterday, it was up about $7. Friday, it closed up $1. So you can see here, $1.10. I'm just reading that column. And Thursday, up a couple of bucks, and then up $8 last Wednesday. However, gold price has been falling over basically since the new week. And I read a statistic that gold had never closed up above 2,000 at the end of October. And so there's been a smash down. I'll get to the smash down here in a moment. It's really going to piss you off. Let's move on to silver first before we do that. Volume's about average for silver right here. Nothing too much going on, but you're going to see a lot of EFPs. Look at this EFP data. This is today's data. 2,360 contracts of 5,000 ounce silver are moving over to that London market. That is astounding. And if we look at the EFP data, well, that's for Monday. So this line is for Tuesday because we're getting Tuesday morning data. This is yesterday's 1960 EFP. Again, December is the pretty dominant contract there. We go to Friday, we didn't have any. We go to Thursday, we only had 100 EFPs right there. We go to Wednesday, we only had 326 on this line, 326. So Monday, Tuesday, people have really been going for the silver. Why? You can't get deliveries because November, there's only 286 open contracts. So what they're doing is they're saying, I can't get deliveries for November, but I need silver. And they're taking contracts and going to London to get it. There may be a supply shortage of silver going on. I'm going to show you the inventory chart of silver registered inventories, the liquid inventories in COMEX. And I think we may be getting a little bit closer to that silver squeeze. I called it a couple months ago and said, are we setting up for the final silver squeeze? Could we be getting close? We're going to look at the potential of a silver squeeze this year, looking at the data. A lot of EFP going on right now, trying to grab silver. That's an indication that there's not a lot of liquid silver on the American market, and I'll show you that. But here's what really is going to piss you off, and it's not as much silver as in gold. Let's go over silver real quick, but then we're going to get to the big one and all the shorting that's going on with gold, especially with the swap dealers. We'll get to that in a moment. This is silver, and this is as of October 24th. So the most recent day that we have, yes, it's a week behind. That's normal for the COT report. It's the way the CFTC does it. Just, you know, we're going to have to deal with that. We don't get real live data like we do on the actual trades for the position. The positioning takes time for them to compile because they get it from different service providers, which they should have a copy of their own data in real time. And I've harped on that, but because of the regulator. But what are you going to do? You know, the regulator doesn't, you know, have a lot of teeth, doesn't have great enforcement capabilities. I've proven that on previous shows. So, you know, we can bitch about that, but it's just the way it is. The first group I always look at is producer merchants. They did increase 936 shorts and reduce some of their longs, expecting the price of silver to fade a little bit. Not completely unexpected because we're not at the supply shortage. So right now, I can kind of see that. The swap dealers, we should call them the swamp dealers or the bullion banks, shorted silver to the tune of 2,551 contracts. It did moderate that with adding additional 758 long. So it's about a 1,700 move short net of both of their positions. The managed money took the opposite of both sides of that trade. They apparently want to go net long about 3,700 contracts. So that's a good thing. The other reportables went net long as well. The swap dealers were the ones that were shorting silver, and they may have legitimate reasons for that. But the overall point to note is that they're now negative short by about 2,300 contracts again. So don't see the silver pop coming. Of course, gold will pop before silver. And look at what happened to gold here a moment. Before I point that out, though, the top 4 traders short 32.8%, a third of the market. Top 8 traders short almost half the market. It's controlled by very few. Most of these are swap dealers. We know that because of the OCC report and some of the reporting we get out of the CFTC and the CME group, that it's the banks doing it, just, you know, and we know it's right here on the chart as well. So the banks are the one that do most of the shorting, and that's what pisses off a lot of the gold and silver investors, physical investors. Now on to gold, and this is really going to make you mad. This is, again, as of October 24th. Look at the shorting going on gold. This is the second straight week in which the swap dealers are bashing the ever-living fucking hell out of gold. Now, I had been reporting for the last 2 months that they have been moving closer to an even long position. Now, they're still a long way away. But at one point, they had gotten under a 2-to-1 ratio of shorts to longs, and it took them about 2 months to get there. They were releasing a lot of shorts, and that market was starting to bubble back up, and it had been recovering since a little bit of a summer swoon. But the last 2 weeks, they've absolutely been hammering it down at exactly the time that gold should be going up, reflecting the geopolitical and the financial risk in the system. And they're hammering the absolute fucking hell out of it. This last week, 24,336 additional short contracts, and to add insult to injury, they dropped 3,359 longs. That's all that you need to look at on this COT report. They're beating, the bullion banks are beating the absolute loving hell out of gold, and that's dropping the price. Of course, the managed money took the opposite and went long, and they're going to lose a little bit of money now, but I am so happy the managed money is doing that, because long term, I think gold price is going to go up. I don't know if they're going to be able to hold their position into that and how long that's going to take. But the reason gold stopped at about 2,000 and came back under was because the last 2 weeks, the bullion banks have been beating the fucking crap out of gold on the market, and it's starting to really piss me off. This was my Twitter post from last week when they did it on the October 17th chart. Now, I realize it's a little bit fuzzy. I apologize for that. But you can see down here this number in red, 19,005 short contracts that they added to the short side and dropped 7,000 long. That's 26,000 contract move to the short side. This is a 27,000 contract move to the short side. 2 weeks in a row, over 25,000 contracts net short by the bullion banks. That's 53,000 in 2 weeks. 53,000 net contracts to the short side in 2 fucking weeks. You want to know why gold price is not going up? That's why gold price is not going up. The bullion banks are beating their crap out of it to keep it from going to its all-time high. What is the reasoning for that? I don't know. I don't think it makes any sense given what's going on in the world. Gold is a fear indicator. Gold is a measuring stick of inflation, which we have a lot of right now. Gold is a measuring stick of what's going on in the economy. Gold is what people go to when there's fears of the financial system, the bank failures this year. Gold is what people go to when they're worried about what the war is going to do to our finances, when we look at interest payments on new debt, when we look at the real estate market crashing, when we look at the fact that people can't get into homes. They're not going to buy homes. What are they going to buy? They're going to buy gold, except for the fact the bullion banks are beating the shit out of it right now. So where are you going to go? You can't buy a home. The stock market's rolling over. Didn't I show you that chart? Where are you going to go? Gold's the only place to go, and they're smashing it down. This really pisses me off. Well, let's look at warehouse inventories. Gold inventory has been falling since silver squeeze at the beginning of 2020, the first couple of months of 2020. Both registered and eligible stocks are down, although you still got millions of ounces left. So gold really has more deliverable on the COMEX than silver does. Not really a big deal. Yes, it's been rolling off. The big hands have been taking gold off, while retail right now is completely capitulating and selling their gold. The strong hands are buying it hand over fist, and net, you know, between central banks and ultra wealthy and pension funds and groups like that, they're buying gold. But retail right now is getting slammed because of inflation, and they're selling. And I'm buying a lot of it in my store. That's how I know. I said somebody come sell me more this morning before I did the report. I'm like, I don't know how much gold I bought the last 2 weeks, but I can't buy any more because eventually, you know, we have to sell for the retail shop to stay open. But the prices are going to come down if retail keeps selling. That's just the way it is. It's going to engorge short-term inventories, at least in terms of the retail sector, not the big 400-ounce bars. Silver, however, this is where we get into potential silver squeeze talk. Something that I've been noting since the beginning of 2021, when silver squeeze started. Physical silver has been coming off, and it's not just retail, because retail doesn't buy directly from the industrial markets. Now, some of the industrial 1,000-ounce bars get remade into coins and bars that retail buys, but this is mostly industry buying this, because we've had major mine shortages the last 4 years, and it's starting to take all of the silver off of the market, and it's going into industrial usage. Look at how many ounces we have. A couple of million have come back on in the last couple of months. So we went from about 30 to almost 40 million ounces, but we're really low in silver, net, everything considered, on the COMEX market. Could we be getting closer to a silver short squeeze? Is that why the EFPs and silver have blown out? If we go back to this chart, this is Tuesday's data, early Tuesday's data. As of about 9 a.m. this morning, 2,360 contracts were presented this morning in silver to move over to London and go hunt for physical. And then yesterday it's 1,960 as of Monday. That's 4,320 contracts in 2 days. And we're not even done with today hunting for silver. Why? Because there's not a lot there. And the shorts don't want to deliver that silver, because pretty soon they're not going to have any. Now, why are we only paying attention to the dark green line? Because it's registered stocks. The eligible stocks could come out into the market at high enough prices if they're not already pledged to something else. Eligible is just, it's warehouse storage. It's eligible for moving into the market, but it's not in the market. Registered is the one, it's in the market for trade. And that amount is really low. And not only that, but the eligible stocks have been falling too. So it's not as though eligibles blowing out more and more stocks and they're just waiting for higher prices and they're going to shove it all into registered. Both of these categories have been falling at the same time. So I don't know if we're headed directly for a silver short squeeze, but it certainly looks like we're getting closer to that point. And when you add up the fact that we're millions of ounces short, a couple of 100 million every year, somebody quoted, and I have not checked this, but somebody quoted about 400 million ounces short in 2023 from mine output to demand. I'm going to wait for that data to come out, but the last 2 years it's been over 200 million, and the last 4 years it's been in deficit. And it looks like that silver's coming off. A lot of the trade, the EFPs have blown out the last couple of days, hunting for silver in the UK. So we could really be getting short of silver on the American exchanges. And again, it's mostly industrial. We haven't even gotten to the monetary demand yet. Gold's going to have to go firmly above 2,000 before people get back into silver for monetary. purposes. And you'll see silver pop 24.50 and then 26, those two resistance points, and go straight up to 30. When you see silver do that, that's monetary demand. That's monetary demand on top of industrial demand, maybe along with some industrial shortages. We haven't seen that in silver. It's not quite short yet. It's getting really close. Gold's going to go first. The monetary demand for gold always comes first because it is really the crisis asset of last resort, and it's the last resort of the central banks, which have been buying it. But it's the bullion banks that are pounding it down. They're pounding down the main signal for people to know that risk elevates. It's not the VIX chart. It's gold. It's always been gold. And for people that hold gold right now, it's really frustrating people. Now, it did get up to about 2,000. I have bought a lot the last couple of weeks from people because they're selling at 2,000, just trying to get as much as they can because they don't trust, I guess, the gold price, which I don't blame them because it's manipulated so much, which I show you every week on the charts. But at some point, retail needs to have higher gold prices because the value of everything else is cratering. The stock markets are going down. They can't afford homes. Baby boomers are sitting on the overwhelming majority of the trillions of dollars of homes. Millennials don't have it. Even the silent generation, most of them have passed away. They have more real estate value than the millennials. The older generations have all the real estate wealth. The millennials don't have it. What are they going to go into? Is there any wonder why Bitcoin popped to almost $35,000 the last couple of weeks? What the fuck else are the millennials and Gen Zers are going to invest in? They're trying to get into gold, and they're certainly, millennials are investing a lot of gold from an ETF perspective. But when the price gets hammered and hammered and hammered like that, where are they going to go? They can't afford a house. They're not going into a declining stock market. Most of them don't even have great jobs and be able to afford the stock market. The greatest myth of the stock market is that most people participate. They don't. The top 1% of people own more stocks than the bottom 99% do. The stock market is an elitist investment tool. Yeah, a lot of people have a little bit in their 401k, but most people, if you're making $30,000 or $40,000, barely making ends meet, you probably stop contributions to your 401k. Or you're only, if you're only making $34,000, the amount you're putting in a 401k is, like 2.5%, 3%. You're getting your match on. You're not building a big portfolio. The wealthy people own the stocks. The wealthy people and the older people own the bonds. These next two generations are screwed. And my generation, Gen X, is kind of in the middle. We're kind of doing okay, just kind of holding serve. But it's these other generations that are getting screwed. And it totally makes sense why, one, they're buying gold in ETF form, but why they're going to Bitcoin. That's the only thing that allows the price to rise, and it's very frustrating to see that the gold's not going up and silver's not going up, and we may be headed to a silver squeeze condition. The good news is that eventually gold and silver are going to have to go up because the debt, you saw that vertical interest on the vertical chart on the interest on the debt. You saw the crash in office real estate. You see the coming crash in residential real estate because affordability is at an all-time fucking low for the last 4 generations to exist in American history. People living in the 48 contiguous states. Real estate has to crash. It has to crash. There's an affordability crisis right now going on, and with raising interest rates, even though we have some decent sales this month, the real estate market has been turning over for a year. It's very clear that with decreased wages and the amount of debt that consumers are taking on, they're not healthy, and this is going to turn. And I think this GDP print, I'm wondering how long that lasts. A lot of that GDP was aerospace, some of it defense, but a lot of it travel. A lot of it wasn't retail buying. Some of it was investment, but a lot of printed dollars go into that. So I don't think necessarily the economy is healthier. I don't think the consumer is healthier at all. I think the consumer is losing. I think a lot of this was driven by government spending and foreign spending on aerospace, and it wasn't driven by our consumer. And even though durable goods orders and inventories ramped up just a bit this month, it's not enough to make up for the free fall decline in both of those metrics over the last year and a half since the Fed started raising interest rates. So, even though we had some decent data this quarter, I really don't see where, the economy has fully recovered and everybody's doing, just peachy keen. So I think definitely some stress there. Now, for those of you interested in gold, I've got a deal for you, and I'm going to show you some of the stuff that we have on sale. We've got Kinesis gold bars on sale, and we're going to go over those. I'm going to show you those if you're interested in getting into a little bit of gold, because I think given the recent price pullback, now may be a good time to have an entry in it, and that's why I put these on sale. So here we go with that next. So we have a lot of gold in the store, and I want to talk to you about the one that we have on sale this week. And I have other stuff in there I'm going to show you as well. We have the 10 gram, the 5 gram, and the 1 gram bars from Kinesis. These are in their assay case. Great prices on those on sale this week only. You can go to the website, You get the credit card price on the website. If you're interested in getting the non-credit card price and you want to do ACH or bank wire or some other method, we can get it worked out. Go to the website www.goldsilverpros.com, click on the volume pricing tab, and click on that link to fill out that little form. And I'll give you a call or an email back. And I can send you an invoice. We can do a transaction outside of credit cards. But if you do the credit card or go on the website, it does have the credit card price for these, but they're on sale. These bars are cheaper than just about anywhere else you're going to find fractional gold bars. Also, I haven't listed these on the website yet. So if you're interested, just purchase some 𝘽𝙗𝙇 from a customer. Have several of these if you're interested in them. One of the cheapest ways to get in, in terms of a government sovereign coin, is a 𝘽𝙗𝙇, one of the most recognized coins in the world, one of the original coins ever produced out of South Africa. You'll have to also go click on the volume pricing and click on the link for that to get access to those you want. And I'll try to get those up on the website this week. Also, I have a Chinese panda, a beautiful panda coin. See, panda on the front that we have in stock. I also have an Austrian Philharmonic. This is a new one. Very beautiful. I just have one of those in stock if you're interested. I also have a lot of fractional gold in different format. These I will get up on the website this week. These are little quarters. I've got a couple of little quarters here. I've got a 1927 coin that's a Netherlands coin, 1927, really nice shape. Probably need to send this off to have it graded and see, if it's worth more than just as a circulated coin. It's a really, really good shape, but that's a gorgeous one if you want a little bit of history. I've also got a couple other fractional coins I'm going to put up on the website. Hopefully by the time you see the video, I've got a US coin there. Got a nice little eagle design on the back. It's a 1/4 ounce with the capital on the front. That was a special bicentennial issue. This is a little bear, what I call a bear bar. It's a Canadian issue coin, about a 1/4 ounce. Has a little bear on the back and the queen on the front. We also have a Somalian coin that I just got in this morning. It's got an elephant on the front and a picture of the crest of Somalia on the back. And then we've got another Canadian issue coin that has the queen on the front. And I'm not sure what's on the back, but it's a gorgeous little coin. We got that one in as well. So I've got a lot of fractional gold. So if you're interested in gold, I've got 2 fractional ones for you. The fractional coins. Here's another one. This is a 1/4 ounce and it's a SIG case. The fractional ones, or we've got the fractional bars if you're interested in either one. Now, a little bit higher premium per ounce on those, but I have brought the premiums down on all of this for you. We'll be competitive to anybody else in the market. But if you can't afford a full ounce, but you're interested in gold, this would probably be the way to go. Now would be a great time because gold prices pulled back a little bit. As I'm recording this, I have the gold price sitting right at $1,985, down about $10 on the day. So a little bit lower prices. If you're interested in getting in on that on fractional gold, we definitely will have that for sale for you. You can order it off the website and pay the credit card price, or you can click on that link for volume pricing, put your name on the form, just put your phone number, email, either one. I'll respond to you. We'll go back and forth and I can send you an invoice and you can pay for that without a credit card using bank wire or ACH, as long as your financial institution supports the ACHs. All right, that's going to do it for today, folks. Massive things going on in the market. Don't let the prices of gold and silver fool you. Given what's going on, I'm not your financial advisor, do your own research, but I believe in my research that gold and silver are going to go up substantially. I believe shortages in silver are going to drive much higher prices as a percentage than in gold, but gold is going to move first, and we're not too far from it. There's a lot of retail capitulation selling going on right now as people need the money because of what's going on with their wages not growing and things like that, and the fear that they have in the marketplace. But the strong hands are buying a lot of gold, and pretty soon there's not going to be a lot of gold. It's been coming off the markets too. So if you're interested in getting into gold, now might be the time to do it, even more so than silver. I think silver is more readily available on the retail side, even though industrial it's getting short. But gold, I think, is probably going to come off the market even potentially first because of what's going on geopolitically and what's going on with the U.S. finances. And it looks like we're going to have a currency crisis probably starting in 2024, maybe second half of 2024, and some currency collapse probably within the next year or 18 months, I would imagine, given what's going on in the world and all the de-dollarization. So if you're interested in gold and silver to protect your finances and to have a little bit of safety, now would be a good time to do it, even though prices on gold are a little bit elevated right now. I totally suspect that during the next stock market and bond market crash, which I don't think is going to take too long, gold reaches probably 2,500, 2,800, maybe even 3,000 this time. It's going to go up quite a bit. There's no resistance above that 2060-ish, 2070-ish level. In fact, there's not a lot of resistance at the prices now. So it could continue just to march straight up, and then silver as a percentage of its value is going to go up even more after gold goes up. And I think eventually silver will go up more because the industrial supply shortages are going to be hitting at the same time that people are going to be demanding that silver for investment purposes. All right, this has been a bit of a long one, but wanted to bring you all the data, all the stories, the economic data, and what's going on with the gold and silver markets. This has been your host, Rob Kientz with goldsilverpros.com.